This is an ominous sign that Canada could be heading for a worse crisis in its real estate market than in 2008. And I think you all know that it is going to be worse. So let's get right into it. First of all, I just want to talk about this real quick, just to show you what's going on. And you'll realize why I'm using Saskatchewan in a second. So 1 in 5 Saskatchewan residents struggling to keep up with mortgage payments, expert says. The Equifax numbers nationally were around 11%. More people right now are struggling with payments. Anecdotally, the amount of people that I'm dealing with right now, it sits around 1 in every 5 people that are trying to figure out how do they make their payments for next month. The mortgage group's Conrad Newfield told CTV News. So, I mean, that is really ominous, isn't it? If 1 in 5 people are trying to figure out how they're going to pay the mortgage next month. I mean, I don't understand how anybody could look at that and think, oh, everything's going to be fine. And obviously, there are structural shortages that are happening in the real estate market right now that kind of make it look better than it actually is. And especially considering we're at the low point for inventory at this time of year. So it's also another point. It's technically always the worst time to buy is in the spring market. The best time to buy is actually in the fall market. And another thing that I want to show you real quick is this, because if you actually look on an income basis, and we were just talking about Saskatoon and Regina, these are technically the most affordable places in Canada when you look at income. So what does that tell you about the state of the rest of Canada? And we know it is in a dire state. There is going to be massive problems coming, which are going to happen in the real estate market. And now we're going to dive into some ominous signs that this is going to be way worse than in 2008. And not only that, way worse than in the US during 2008. So let's get right into this. So first of all, I want to take you to this. So first of all, I want to show you that during the interest rate hikes that happened prior to 2008, prices actually rose in Canada. Like, prices didn't actually decline. So that's one thing that I want to show you. So prices were actually rising during the interest rate hike cycle back then. And that is really interesting. In fact, if we flip over to this chart, you can see that rates were rising, in fact, until around November 2007. And then that's when they started to cut rates. And funnily enough, when you actually look at the chart here, it was only actually when they started to cut rates that real estate prices started to fall in Canada during 2008. So isn't that really, really interesting? Because that is the opposite of what the industry would expect you to believe right now. Now, in the US, it was the total opposite during the Fed tightening, because it was more extreme for a start off and the price growth had been way more extreme. You essentially did have prices drop. They dropped around 11%. So Canada didn't drop at all during that hiking campaign, and the US did. They dropped 11%. So now let's see how much Canada is down during the interest rate hiking cycle this time. And as you can see right here, it's down near 20% in 1 year. And this is just the interest rate hikes. And what I'm trying to show you in this live stream is that interest rate hikes, yes, they do affect the real estate market, obviously, and especially when affordability is stretched, which it absolutely is in Canada. I mean, this 19% decline, that's exactly what it's telling you, in fact, that affordability is in fact stretched, very much so. So we know that now, but what about what happened in the US? Well, prices were down 11% during the hiking cycle that the Fed did prior to 2008. So isn't that really interesting? We're double that. We are double that in terms of the decline. And you guys know, you guys know, those of you that are smart out there, know that the real estate market, something that is kryptonite for the real estate market, is a recession, is unemployment going up. So this whole narrative that I think is brewing around like interest rates coming down, now is going to be a great time to buy, I think just could be catastrophic for a lot of people, because it's mostly those people that buy towards the end that end up losing their homes because they end up in so much negative equity. And quite frankly, some of the markets are just so stretched, even with the declines that they've had. And in '08, you had markets falling 30 to 50% in some cases after and on top of the already 20% declines that they might have had. I mean, it was 10% in the more affordable areas, but it was 20-30% in areas like Phoenix prior to 2008. And then they fell like another 40 to 50% on top of that during the recession, and when credit got tight. So that is really interesting. And then also, if you look at this chart, it was actually during when GDP actually went down that happened. Now, I don't believe GDP is really a good number that we can even use anymore, because the government is so out of control in Canada. And you have to understand that GDP includes all their spending, and their spending is so out of control that you can't really look at GDP as an accurate view of the economy. But it gives us sort of a high level overview of the economy, I guess you could say. And if you dive into the back end data like I do on Statistics Canada, you can kind of you can see which areas are weak and which areas are strong, and it's your usual areas that are strong and weak, as we would all expect. So another thing that I want to show you is just, again, like, this has gone up an insane amount since 2021. In fact, it's grown over 30%. I mean, that is just not natural, guys. Loans to private sector have grown 30% since 2021. And just look at the growth since 2010 or since 2008. And this is really, really bad, because a lot of these loans have probably gone into commercial real estate, other things to do with real estate, because we know how dependent the economy is on real estate. And I think this is really bad, because you've also got to think, if a lot of businesses are holding a lot of debt, interest rate hikes are going to affect them. Tight money is going to affect them, which I believe as interest rates come down, you're going to see the tight money influence go up, which will affect things even worse, because essentially banks will be looking at businesses and nitpicking stuff and saying, actually, we don't want to take the risk with you right now, because there's a liquidity crisis, there's a liquidity shortage, which we're seeing happen throughout the banking system. So really, really interesting. And then obviously we know household debt to disposable income, it's just at absolutely insane levels right now. So all of this kind of tells you essentially what is going on right now, and kind of can paint a picture of what you should expect to unfold. And the other real thing that is so funny, and I again found this so ominous, was from Q1 to Q2 in 2008 in the US. Guess what? Housing prices actually went up around 2%. So that's really interesting to note, because if you think about it, we could see that exact same thing happen this year. And it could actually be more extreme, because we saw a much bigger and much larger decline than the US saw. So it could go up 3-4%, and that could happen over a couple of quarters, because obviously you're going to have more FOMO that comes with that, more emotions, everything like that. So that is really something to bear in mind. I'm not expecting a massive decline in prices during the front part of this year, the next couple of quarters. I'm really not. In fact, I'm expecting quite the opposite. I think prices could rise. It's going to get very uncomfortable for people who are waiting on the sidelines and buyers. But you have to look at stuff like this, and then you really realize that historically, the probability is that when the recession hits, you're going to see declines in prices, and that's exactly what we saw in 2008. And the other thing you have to remember is just the debt levels are so stretched right now. The probabilities are completely in your favor if that's what you're waiting for, and that's what your plan is, to sit on the sidelines and wait. The probabilities are in your favor. There's always the chance that prices could go parabolic because they do some gigantic stimulus package or something insane, right? There's always a chance of that. And you just have to weigh up all the risks and not buy based off your emotions, okay? So just realize where the probabilities are going. And, you know, the economy right now, I mean, buying a home, buying more real estate, in my view right now, that is essentially going long the Canadian economy, right? Even if you're buying an investment property, because you're relying on the tenant and the economy to be well in order for that tenant to keep paying you. And everything's a probability game. You have to think about that. The chances of your tenant defaulting on your rent are higher during a recession. You have to consider all these things. Once you think more in probabilities, you're less susceptible to all the human emotion that people get caught up in and essentially drives them to make poor financial decisions in their life. And it's really that simple. So anyway, guys, I want to thank you so much for watching. If you enjoyed this video, you might like either of these videos. I'm honored to have you as a viewer, and I will speak to you in the comments below. Have a phenomenal weekend, guys. See you there. Bye-bye.